Alright, so in this video I wanted to give an example of how covered calls can save you or save your position or generate an income from your existing positions or even reduce your cost basis on a position. So even if you're down 43%, for example, look at this position here I have on Alibaba. Average price is $181, it's worth $102. So I'm down 43% on the stock, but with covered calls, I'm still able to collect something from it. I'm still able to generate income from it, and I'll show you an example. Another example here is PayPal. I'm down 60% or almost 61% on PayPal. Average cost price is 186. Price right now is 72.90, but still generating income from it. And the other example is Zillow over here. 100 shares at $40. And right now stock's trading at 29. So it says here I'm down 27%, but I actually didn't buy this at 40. My shares got called away from selling a covered call, and I just ended up buying it back on Monday. So that's why it shows 40, but I think my cost is around 55. So my cost is 55 and the stock's at 30. So I'm down about 30 divided by 55. So I'm down about 45% on this position as well, but I'm still able to generate income from it. All right, so I downloaded the account activity report from Questrade. Let me just hide some cells here that we don't need. And maybe we don't need this either, commissions and stuff. Okay, all right. So from Alibaba, that I started selling covered calls on Alibaba. It says here August 18. I guess that was the first one I sold with October 15 expiry, and then I bought it back. Okay. All right. So if I just highlight this column here with all the calls sold and bought back on Alibaba, it gives me a total of $2,600 US. So that's since August. We are June, so it's about 10 months. So in about 10 months, 2,600 times 1.28 divided by 10 months. So it's about $332 a month, which is not bad, given that the position is down. The position on Alibaba is down 43%. So if we compare it to my cost of 181, it's as if I'm making divided by 18,000. So if I'm making 1.8% a month, right, times 12, it's about 22% a month, which is not bad, really. 332. Actually, the 18,000 is in US, so I should multiply the 18,000 as well. So it's about 3328. 332 divided by 18,000. So let's do that again. So 18,100 times 1.28. So 23,168. So it's about 332 divided by 23,168. So it's about 1.4% per month divided by times 12, sorry. So it's about 17% a year, which is not bad from a stock that is down 43%. So all I'm really doing on Baba is selling an out of the money call every week. But I wait for a green day on the stock. So I wait for the stock to go up 2 or 3%, 4%, and then I sell an out of the money call for the week. So I keep it short term, and they tend to expire quickly. And in fact, last week for June 17, I had an expiry of 115. The stock jumped almost to 112 pre-market. It was crazy for some reason. I have no idea why. So you can see here the last 5 days. Look at this crazy jump here. So I already had a call before going into this crazy jump at 115. But what I ended up doing is I ended up rolling it to next week. So from June 17th to June 24th. And then look at Baba come crashing down. So when it came back down, I was able to close that call position as well from next week. So I rolled it for a net credit of 90 cents and then bought it back for 38 cents. So the difference is the profit that I made for next week already. And now my position, my Alibaba position, does not have a call on it. So it's not a covered call now, it's just shares. But I'm waiting for the next green day on Baba to sell an out of the money weekly call. I've been doing that since, as you can see from the spreadsheet, I've been doing it since August. You can see October, November, December, January, February, all the way to June 10th, and I guess it's missing what I did yesterday, June 17th. It's not up to date yet. But yeah, so it's probably an extra $50 probably from yesterday as well. So what did I have here? I had 2617. So it's about almost $2,700 US from just selling calls on a position that's down 47%. So the idea is, what I'm trying to say here is, if you buy something that you like, that you trust, even if it's down, you could continue generating income from it by selling calls. But there's an element of luck, of course, because you don't want to get called away. You don't want to lose your shares at a strike that's lower than your cost price. So my cost price is 181. I'm selling a call at 115. But if my shares get called away at 115, then I lose my shares at 115. I end up selling my shares at 115, but my cost is 181. So I lose the difference in capital. So the idea is you try to pick a strike that that has a good chance of staying out of the money. I try to do that by selling on a green day. And if it does get breached, then I just roll it. It becomes harder to roll. I did get breached on Alibaba a few times. All I do is I roll it to the following week, and I get lucky. The stock ends up coming back down again, and below my short strike. But if the stock continues up for several weeks, then it can get problematic. I can end up losing my shares at a strike below my cost. So it does come with a risk. There's no risk. You can't say that there's no risk, but that's what I'm trying to do from these positions that are down so much. Next year I got PayPal here, 186, down 61%. So this one hurts a lot. I'm actually thinking of selling this and just buying the triple Qs instead. So going back to what I was saying about Alibaba is, I could, instead of buying a stock, I could just buy an ETF, like the Nasdaq ETF, the triple Qs, and then even if it drops, I'll just continue selling calls. And then what I could do is take those call premiums and then maybe buy more shares with those call premiums. For example, PayPal. Let's look at PayPal. Let's look at the last call I sold on PayPal. So PayPal here, last one here is over. PayPal's over here. So $42, $68, $44. That's what I'm collecting from selling PayPal calls every week. So I could actually take this $68 or $42 and buy more shares of PayPal. That's if I like PayPal and want to buy it at this price. Right now, I'm not sure. I'd rather buy triple Qs, but if you're doing covered calls on a stock that you like, then you could end up buying more shares with the premiums that you collect. So it's like dividend reinvesting. It's like the drip plan with dividends, but you're doing it with call premiums that you're collecting right away, not every 3 months, and then you could use it to buy more shares right away. So regardless, with PayPal, I started selling PayPal calls December 13, and then I've been doing it weekly, trying to do it weekly out of the money and trying to pick a strike that stays out of the money. So on PayPal, I've collected about PayPal over here. I've collected about $27.79. Probably this one should not count because this is just me converting it from a naked put from my margin account to a covered call in my TFSA. So I'm not going to count this one, and this is me buying it back, I guess, February 18, yeah. So this is me buying it back, so I'm not going to count this one, so I'm going to start from here. So if I'm going to start from here, then I collected about $1,500 US on PayPal since February 2022. So February to June, February, March, April, May, June. So about 5 months with 1,536. So not bad either. 1,536 times 1.28 divided by 5 months is about $393 a month, which is really not bad. It's better than a dividend stock, right? This is actually pretty good. I'm surprised. I didn't expect this. This is the first time I'm actually calculating this. Let me just think here what that means now. So now my PayPal shares are down 60%. So yeah, I'm down 11,000 on the shares on the position. But at least while I'm waiting for PayPal to recover, if it does recover, at least I'm generating, $393 a month if I continue to sell out of the money calls without getting called away. So the last one here, let's look at the last PayPal call I sold here. PayPal, the last one, as you can see, I sold it on June 15 for June 17 expiry. So with only 2 days, I sold the 79 strike. I collected $42, and I actually could have gone closer because PayPal expired at closed at 73. So I could have sold the 75, 76, 77, and I would have collected more. But I try to give myself the best chance of not getting called away. So picking a call strike that will expire out of the money so that I don't lose my shares at that strike, since my cost is way high at 186. So let's look at how much does that give me? So if my cost is 186 times 1.28, so it's about 23,800, ridiculous. All right, so 393 divided by, what was it again? 26,000, I said? So about 1.5% per month times 12, it's about 18%. So it's as if I'm generating 18% dividend yield on a position that I'm down 60% on. Yeah. Hopefully I can continue this way and I don't get called away. But yeah, that's the plan. And then next year I've got Zillow here that I'm down. It says here 27, but I'm down maybe I think more than 40%. But let's see how much I've collected in covered calls or in calls from this position. So Zillow is around here. So Zillow, you can see I collected about $800 US, and I started selling it December. So December, January, February, March, April, May, June. So about 7 months. So 802 divided by 7. 802 times 1.28 divided by 7. So it's about 146. So if you add up all the, what's the other one? PayPal was about 390. The other one was Alibaba was about 330. So it's about $866 a month just from selling call premiums. If I want to consider it as income, I'm down on the original capital, yes, but this let's say I had bought a dividend stock that pays 4% a year. If I'm just looking at the income portion of it, in this case, with these 3 positions that I'm down over 40% on, they're still generating $866 a month. But I'm not using the cash. I'm not taking out the cash. It stays in the account either to buy more things or to buy back the call options and roll it if I have to. But yeah, so the idea of this video was to show you that even if your position is down, you could still sell. You could still generate income from your position by selling calls out of the money weekly. I prefer weekly because it's more unlikely that this stock surpasses your strike when it's a short-term trade. But if you give it enough time, like 30 days or 45 days, it has enough time for the stock to surpass your call strike. Also, the return per week is better when you sell short-term. When you sell weekly, the annualized return will be better, will be higher. And the weekly decay is so much faster as well. So I prefer selling weekly out of the money calls when my position is in trouble. Because if I had to pick the same strike, of my cost, which is like 186, for example, on PayPal, I'm not going to find any premium. I'm going to have to go to January. I'm going to have to go 1 year or 2 year out, which has no return. So I find this much better. So I just wanted to share this with you. So if you have any questions, leave in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. Thanks for watching.